All right, welcome back, welcome back, welcome back, welcome back. This is Tony George, and I'm super excited to have you graduate from the beginner's course and into the intermediate course. It's a great honor to have you here, and we're going to be learning a little higher things from the things that we learned in the beginners courses. All right, so that you have gone through the beginners course, I believe you understand everything you learned, and do well to always practice the things that you learn. It is by that way you can become a master yourself. All right, thank you so much. So as always, grab your pen, grab your notes, and listen attentively to all the things that we're going to be talking about in this intermediate course. Okay. Um, I promise you it's going to be nothing less than wow. So let's jump into business for today. These are the things that we're going to be talking about. Some frequently asked questions. We'll look at those questions, and those questions will lead us into knowing what we would be learning today. All right. We're also going to be looking at the technical analysis, the Japanese candlesticks, what a trend is, how to identify and classify trends, why trend lines are so important that we must talk about them, how to draw trend lines on charts, how to trade with trend lines, identifying dynamic support and resistance as well, which is also very key and very important. And then also we're going to be talking about how to spot trading opportunities using moving averages, moving average crossovers. All right. Then we're also going to be talking about moving average, convergence, and divergence. Now, this is super rich. Can we get into business? All right. Just a quick one. What are those frequently asked questions concerning forex trading? Now, number one, a lot of times people ask when is the right time to buy or sell. A lot of people want to know, sir, when can I go in the market and when can I go in the market to buy this asset, or when can I go in the market to sell this asset? It's very important that you know, because once you're able to know this, then you get one of the most important things that is required to trade the global financial market very profitably. All right. Then when do I get off the market? Also, a lot of people get into a beautiful market but do not know when to get off the market. All right. So we're going to also be talking a little about that. Now, all of the things we're going to be learning are going to be geared towards answering these questions. All right. So once you follow keenly to the things we're going to be learning, you will notice at the end of the series or at the end of the course that you probably have answered these questions in very many ways. The third question is, where do I place my stop loss and take profits? Then the last but not the least is, how do I validate my analysis on the market? How do I validate? How are you able to validate if this trend is still going up or if this trend is still going down? All right. Or how do you validate? How do you know? How do you know? All right, we're going to see how we can also answer questions like that. Now, by the end of this course series, you should be able to answer all these questions and make the right decisions on the market. Of course, that's the whole purpose of the intermediate course series, that you'll be able to make the right decisions on the market. So I believe this is going to be so interesting. Can we get to business? Okay, let us look at technical analysis. Now, technical analysis is the study of the historical price movements to anticipate future movements of the prices using the charts as the basic tool. All right. So, when we talk about technical analysis, think of it that we're trying to know where the market is coming from, and where the market is actually going to. All right. That is the whole essence. Trying to study what has happened in the market previously so that we can use to analyze, we can use to tell where the future prices are also moving to. And we do all of this basically with the help of our forex chart, right? We do this basically with the help of what? Our forex chart. Remember, I've talked about the forex chart, right? And I told you that we have the bar chart, we have the line chart, and also the Japanese what candlesticks chart. All right. So with the help of the chart, we're able to study the market, study we are able to study market movements, previous market movements, and then take a decision on where the market is also what going. Now, the aim of a technical analyst is to try to understand price movement patterns so it predicts the future trends of the market. A technical analyst is someone who tries to understand how prices move in the market so that you'll be able to predict in future where those trends are actually what moving to, where the market is actually the direction of the market. Is it going up or is it going down? Now, to achieve a proper study of the market, one needs to have a knowledge on the following. You need to have a knowledge on the following. One, the Japanese candlesticks, its formations and its patterns. Very importantly and very shortly, I'm going to be showing you this very important thing, this very important lesson in the forex market. All right, the Japanese candlesticks, its formations and its patterns. And also very shortly, I'm going to be showing you another very important thing, which is trend lines and market structures. All right, trend lines and market structures. All right, I'm going to be showing you this, and then we'll touch a bit of market indicators, and that will be it. Now, by the time you're able to know these three, you can have a proper study of the market. Now, every knowledge that you get about the forex market, it helps you, it shapes you, it makes you a better trader. And that's why these three are going to be they're going to be the building blocks upon which we will carry out proper study on the market. And that is why I need you to pay so much attention as we begin to unravel these things. Okay, so let's go into the Japanese candlesticks now, which is the first one. Now, a candlestick charts display market movements in much greater detail. Candlestick charts display market movements in much greater what detail. That is what I was talking about. We have the line chart, we have the bar chart, but none of these two types of forex charts display movements it displays the sentiments of the market participants as much as the Japanese candlestick does. All right. So the Japanese candlesticks displays the sentiment of the buyers. It displays the sentiment of the sellers. It tells you precisely when buyers are getting weak. And so sellers are positioning to take over the market, or sellers are getting weak and buyers will probably up in. All of these things you will see them play out with the Japanese candlesticks. I'm going to show you really shortly. All right, let's just finish this. Now, its analysis is all about reversal and continuation patterns. All right, so the Japanese candlesticks, its formations and patterns is all about reversal and continuation patterns, which happens in the financial market, but is also introduces another important element, which is what market psychology. Just like I said, it will let you understand the sentiments, the psychology of these people who are actually participating in that market. Okay, so candlesticks allows an investor to read the changes in the market's determination of value, also referred to as investor sentiment. Okay, just like I have also earlier mentioned, you're going to be able to understand the you're able to understand investor sentiment. What are these guys thinking about? Why does this happen in the market? Now, the Japanese candlesticks will help you to understand. Mainly looking at the Japanese candlestick, you should be able to say that okay, there is so much volume, or there's so much liquidity in the market. All right. Merely looking at the Japanese candlestick, you should be able to say that the strength of the sellers are gradually nosediving. Of course, with the candlesticks alone, you will be able to do all of that. Investor sentiment. Okay. So candlestick charts show the interaction between buyers and sellers, which in turn is reflected in price movements. Candlesticks allows an investor to read the changes in the markets. Sorry, okay, I've talked about that. So candlesticks charts show the interaction between buyers and sellers, which in turn reflects in the prices of a particular asset. All right. So let us look at what the candlesticks looks like, because we've been talking candlestick, and a lot of people have been wondering, is it a candle that I know that I do light when there is power outage? Of course. Okay, now let's analyze that candle first. That candle that you know, let's analyze it, and then we will use it to better explain the type of candle that we're talking about. Now, remember, the candle that you already know It's looking something like this. Pardon me if I'm not able to draw very well. Okay, okay. And then it has the wick. Am I right? Most times it has the wick. The wick runs through the real body, the body of the candle, down to the bottom part. All right. So sometimes you see a very small part of the wick comes out. Now, this is a candle that we have, right? Now, this candle has from this point here, right, down to this point, we have the body of the candle through. Now, from here up, we have the wick, and so invariably the body of the candle is what we call the what? The wax. We call it the wax, which is what? The body, right? Beautiful. And then we also have the wick. The wick is what we call what? The shadow. True? Beautiful. So looking at a typical candle, we have the body and also the shadow, or we say we have the wax and also what? The shadow. This is the shadow, the lower part here that protruded out of the body, and the upper part, which we normally what? Light. So it simply means that a candlestick is made up of a real body and also what? A shadow, or we say it's made up of a wax and also what? A wick. Now, if you understand this, then you will definitely understand the Japanese candlestick. So let's quickly look at the Japanese candlesticks. Okay, let's quickly look at the Japanese candlestick. Now, remember that I have actually talked about the bullish movements of market in our beginners course, and there are also the bearish movements of the market. So it simply means that there are two people in the market. There are the bulls, the buyers. They are called the buyers, the bulls. All right, they are the people. The buyers are rather are called the bulls. They are the people that appreciate the prices of a particular asset. All right, so once they are dominating a particular market, what you would notice is that the price of that particular instrument keep appreciating. All right, it keeps going up, it keeps going up, keeps going up. So you know that this kind of market is what? Dominated by who? By the bulls. All right, then we also have the other set of people in the market who are called the bears. The bears are those who depreciate prices. All right, they are the sellers. The bears are called what? The sellers. Once they dominate a particular market, what you notice in the market is that the price of that asset will keep depreciating. And so you see something like this on their chart. From $10, you see it moving all the way down to $3, right? They depreciate prices, right? When they are when they are dominating the market, they depreciate the prices. Now, I've explained these concepts. I've explained the concept of the candlestick. I've explained the concept of the bulls and the bears one more time. Let's now put it into the Japanese candlestick. All right. So the Japanese candles are actually designed by the Japans. It was actually designed by the Japans to for them to be able to monitor the changes in the prices of their rice that they sold at the time, and also to understand the future market. All right. So what basically they do is this. What basically they do is this. If today was a good day for them, let's say a bag of rice was sold for, let's say this is a chart, pardon me. So let's say today a bag of rice opened at the price of, let's say this price is 5,000. All right, this is 5,000. Let's assume a bag of rice sold for opened today. As today market begun, the price of rice became 5,000. What the Japans do is that, okay, the value of rice has opened at 5,000, and then they will continue to monitor the changes in the price of that of that particular asset. So still within today, the prices hiked up to, let's say this is 6,000, right? This price level, let's say this is 6,000. Okay, now it got to 6,000, but remember, in the same day that the prices of this rice is appreciating, we also have the set of people that will want to depreciate the prices. They are called the bears. They are the sellers. So the sellers can hop in the market from here and still depreciate prices. So you see the buyers and the sellers within the day will be taking prices up and down because it's a fight between the both of them. All right. Buyers will want to appreciate prices, sellers will want to depreciate what? Prices. All right. So we will have that fight. In fact, there could be some times that the sellers will seem to dominate the market and push prices even lower than 5,000 naira, at which the price actually begun that day. So you that is where you see the market actually went down, let's say to 4,500, and then you see a week now representing it. This shows that the market was here before. This is where the market opened. So this is the opening price, right? This is where the market opened. I mean, this price. Let me see. Okay, so this is opening price. This is where actually the market opened. And then this particular price here is now the lowest point. Is now what? The lowest point. This is where the market actually got to. All right. This is where sellers were able to push the prices. So I mean this price level. All right. But then the day hasn't completed. The day isn't finished yet. That simply means that there is this struggle between the buyers and the sellers will still continue up until by the end of the day, you might find out that buyers were able to push prices up to even 7,000, but finally they closed at 6,200 naira per bag. But then this market actually got to somewhere around 7,000. So this is what you see. So let me put in the figures and then we make the final. This is high and this is close. All right. So this is where the market opened O, and then sellers were able to push prices to this point. But this is the lowest point sellers were able to push prices within the day. All right. So we have that as a low, and then buyers gained momentum and dominated the market massively and pushed prices up to this point, 7,000. But finally, because they are not the only ones dominating the market, sellers were also able to push prices, and prices closed at 6,200. Now, let me ask this question: who dominated the market most? Looking at what I have explained with this candle, who do you think dominated the market most? Of course, it's the buyers. The bulls were able to dominate the market the most. All right. So it simply means that we will define a bullish candle as that candle that represents a bullish dominant session in the market. A candle whose closing price is higher than what? Its opening price. A candle whose closing price is higher than the what? Opening price. But the reverse is the case for a bear dominated market. The reverse is the case. All right. So permit me, I'll take this really quick. Let's assume that this is price level what? 7, right? Now, let's assume that the bag of rice opened at 6,000 today. All right. But buyers were able to push prices up to 6,500. All right. Now, the sellers, because they dominated more of the market, so the sellers were able to now push prices, okay, from 6,000 to 5,600. They were able to push prices to, let's say, 5,000, let's say 5,300. This is the price level of 5,300. Okay, no, no. They were able to push prices to, let's say, somewhere around 4,900. All right. But then buyers still dominated a part of the session. And then finally, by the end of the day, the market closed at this price of 5,300. Remember, the market opened at 6,000. Sellers were able to dominate the market, pushing it down to 4,900, but buyers were able to push up the prices from 4,900 and the market closed at 5,300. So this is how we're going to have it. So this is the opening price, Okay, this is the closing price. This is the highest point the market experienced that day. All right. Sorry. This is the highest point the market experienced that day. And this is the lowest point that the market experienced this day. Now, you see that this is a little different from the first candle that we drew. All right. The first candle that we drew, the closing price was higher than the opening price. That is a bullish candle. Now, when we talk about a bearish dominated session or a bearish candle, the closing price is lower than what? The opening price. All right. So we have the bear candle and the bull what? And the bull candle. Now, beautiful. So let's quickly look at these now. So this is a bullish candle. You can see the opening price. The closing price is higher than the opening price, but this is the highest point the market experienced within that session. All right. Then this is the lowest point the market experienced within the session. Remember, I've already told you that the candle has the real body and also the shadow. So in this case, we have a lower shadow or a lower wick and a upper shadow or called the upper what? Wick. All right, the same happens for that of the bears. Okay, so let's quickly look at a few more things about the candle. Now, long bodied candles indicate strong buying or selling. Long bodied, we talked about the body. If the body of a particular candle is long, what that means is that there was a strong buying activity or a strong selling activity. The longer the body is, the more intense the buying or the selling pressure. Now, this means that either buyers or sellers were strong, were stronger and took control of the market. That is what it simply means. All right. While short bodies imply very little buying or selling activities. So once the body of the candle is small, it simply implies that there was little buying or selling work activity. Let's quickly find such kind of candles that we are talking about. This is a long body candle, like you can see here, right? Now, what this implies is that there was a um, there was a there was a strong buying activity within this session. Bulls were able to dominate this particular candle session, all right, and then push prices up. All right. When you see a candle like this, is a bear candle. This is a bear candle because it forms. This is the opening price, and then it fell down to this point. This is a closing price. Now, this shows that there was a strong selling activity dominated within this session. All right. And then we have the ones with smaller bodies, like you can see this one candle here. You can see this candle. You can see this. Now, I'm going to be telling you a whole lot about all of these candles. They all have names. This is called the Marubuzu. This is called the dragonfly. Looks like that of the dragonfly. Yes, this particular one that does not have body, that the opening price and the closing price are the same. It's called the dragonfly, right? I've called this. This is called the marubuzu. This is called the spinning top. You can see this now. This is called the spinning. They all mean something. They all mean something. All right, they all mean something. This is a drag. This is a dragonfly. This is a dragonfly candle. It's actually a type of a dodgy candle. So let's not waste time. Let's quickly go into that now. So the basic candles that we want to look at, number one is the doji. I just mentioned the doji. Now the doji is a candlestick with little or no body. The doji is a candlestick with little or nobody. Now this means its opening price and the closing price are same or very close. All right, they are almost the same or they are very close. It most times indicates indecision as both the buyers or sellers fail to drive price towards their favor. All right, so now this is exactly what the doji is used to identify in the market: indecision. So whenever you see the doji, you know that neither the buyers nor the sellers are dominating that particular session. There is an indecision. All right. Now, what are the types of dojis that we have? We have the long-legged doji, we have the dragonfly doji, we have the gravestone doji, we have the four price doji. Now, this is how the long leg look like, and then this is how the dragonfly looks like. Okay, this is the gravestone. Now, we're able to spot some of these, all right, already on our chart. All right, this is what? This is a long leg dodging. All right, this is a long leg dodgy. You can go back and check. This is a long leg dodgy. Now, notice that the body of these candles are very small, or its opening price and closing price is almost the same. That is why, let me zoom in so you can still see if you want to see. Can you see this now? It has a body, but it's very small. You can not even easily notice it. All right. So this is long leg dodgy, and I think I saw beautiful. This is a dragonfly. This is a dragonfly. All right. So all of these simply means what they once you see them, it simply tells you that the buyers, not the sellers, are dominating the market. It simply shows indecision in the market. All right. So that's for the dodging. Okay. That's for the dodgy. Let's look at the next candlestick, the Marubuzu. The Marubuzu. Now, the Marubuzu candle is a bald candle. Now, the word Marubuzu in native Japan simply means bald. It simply means somebody does not have hair on his head, or he has very little hair on his head. So his hair is termed what? Bald. Now, that's exactly what we talk about when we talk about the Marubuzu. It's a bald candle that is without upper or lower shadows. There is no air on top, or there is no air below. All right. There is no shadow on, rather, there is no shadow on the candle, on the real body, or there is no shadow or wick also at the lower part of the candle. Now, depending on where you find this Marubuzu on your charts, the Marubuzu can indicate continuation or reversal. The Marubuzu can indicate what? Continuation or what? Reversal, depending on where you find the Marubuzu. Let's identify a Marubuzu. I think I saw one. I saw one Marubuzu. Let's identify one. Let's Beautiful. This is a perfect example. This is a good example of a Marubuzu. You can see this here. It has very tiny upper shadow and also a very small lower shadow. But this is also a Marubuzu. All right. The upper and the lower shadows are very small, but it has large real body. All right. So these are Marubuzu. Now, once you find the Marubuzu, most times, depending on where you find them, if you find them at the middle of a trend, it simply tells you that the sellers are very strong and may likely push prices even forward, further downward. All right. If you find the Marubuzu, the bullish Marubuzu, at the middle of an uptrend, what it simply means is that the buyers are so powerful that they might likely push prices even further above. All right. Now, that is exactly what the Marubuzu is used to indicate if you find it at the middle of an uptrend. But if you find it at the end of a downtrend, it can tell you that the strength of the sellers are getting to exhaustion. All right. Now, let's quickly continue. The next we have is the spinning tops. The spinning tops. The candlesticks with long upper and lower shadow, which is also called the wick, but small real bodies are called the spinning tops. All right. Now, I want to make this, I want to put this statement. The spinning tops and the dodgy are looking alike, all right? But there is a little difference. For that of the dodgy, the body of the candle is the close of the candle is almost the same with the opening. So it has a very tiny real body. But in the case of spinning tops, it's still close. The opening price, the closing price is still close to the opening price, but at least it has a body. There's a real body, but the real body is pretty small. All right. Now, they also indicate indecision or weakness of both the buyers and sellers in the market. All right. So whenever you see the spinning tops, one of the things that should come to your head, to your mind rather, is indecision. All right. Indecision in the market. Or it tells you that the strength of the buyers are getting to exhaustion, or the strength of the sellers are also getting to exhaustion. All right. That simply means that, of course, if the strength of the sellers are getting to exhaustion, the market will quickly be dominated by the bulls who will try to want to push prices what up. And if you find the spinning top at the end of an uptrend, most times, where it indicates that the strength of the buyers are getting to exhaustion, you know that definitely the sellers will enter the market and would want to push prices what downward. All right. So all of these are things that you should understand about the market. Now let's quickly look at how we can use candlesticks to generate signals, and also how these techniques work. All right. So first we'll talk about the hammer and the hanging man. The hammer and what? The hanging man. Now, the hammer and the hanging man both have small real body with long lower shadows. with what? Long lower shadows and little to almost no upper shadow. Now, little to almost no, of course, you know how the hammer looks like. The hammer has the part we hold, which is very long, and then the head of the hammer, which is small. Now, exactly how the hammer candle looks like, all right, just like we have here, all right. So it has long lower shadow, but a very tiny upper shadow with small body. The same thing for the hanging man. Now, what is the difference between the hammer and the hanging man? The difference is that the hammer is a bullish candle, while the hanging man is what? A bearish candle. So once you see these form as a bullish candle, you know that's the hammer. And once you see it as a bearish candle, depending on the color you're using, you know that is what? That is a bearish candle. All right. So let's quickly look at what the hammer and the hanging man tells us when we find them in the market. Hammer in a downtrend indicates the weakness of the sellers, and that price will start rising what? Again. So if you find a hammer in a downtrend, all right, it indicates the weakness of sellers, and that price will start what? Rising again. Now it signals a possible bullish reversal. It signals a possible bullish reversal when found at the end of a downtrend. All right, that is the hammer. Once you find the hammer at the end of a downtrend, what it signals is that there could be a possible bullish reversal. That is, a market was selling just like we have in this image. The market was selling, and then we got the hammer at the end of this downtrend. All right, now how do you know the end of a downtrend? Of course, you can go back and watch, you can go back and learn about the support and resistance. It is a very beautiful way to want to know the end of a downtrend or the end of an uptrend. Okay, that the support and resistance will help us know all that. Okay, so once we find the hammer at the end of this downtrend, what this simply means is that the strength of the sellers are getting to exhaustion, and the buyers could probably up in the market and push prices what? Above. All right, this is what this hammer simply means. The same thing for the hanging man. If you find the hanging man, um the hanging man, if you find, okay, the hanging man in an uptrend indicates the weakness of the buyers, and the prices will start to fall again. It signals a possible bearish reversal when found at the end of an uptrend. So once you find the hanging man at the end of an uptrend, what it signals is what? A possible bearish reversals. Why? Because the strength of the buyers are getting toward exhaustion. So let me just quickly teach you how we can use this to place trades, all right, to get a trade set up. Now once you see the hammer at the end of a downtrend, that does not mean you just rush into the market, you just quickly go into the market and you want to buy. Of course, no. So what you have to do is this: you have to wait for the next candlesticks to validate the hammer that you found at the end of the downtrend. The next candlestick, if it is a bullish candle and then it forms at least below above the midpoint of this last candle, then you know that okay, this market is gradually warming up to be dominated by what? The bulls. So you prepare yourself and take a what? A buy trade. Now let me quickly show us the trade setup. All right, let me quickly show us the trade setup. So let's assume this is what we got the signal, all right, that there could be a possible bullish reversal, and then we decided to find a support level or a good entry price. So this is where we enter the market, right? Okay, this is where we enter the market. Now, where are we going to put our stop loss? Our stop loss can be placed at the low of this candle. All right, that is one of the ways to determine the stop loss. But I'll teach you many more ways on how to determine stop loss on the advanced class. All right, I'll teach you so many ways you can use to determine stop loss and also take profit levels in your trades. All right. So this now we're buying. So we enter the market here. This is the entry price. This is the what? This is where we place our stop loss, and then we can find a significant support zone. All right, to also want to what? Take profit. So we have our take profit here. Okay, so let me put in the values. We have our entry here. We have our entry here, the entry price, and then here we have take profits. We have our take profit here, and then here we have our stop loss, right? Beautiful. So this is a perfect example of a buy setup. You buy, your stop loss is here, and then you take profits here. The same thing happens when we want to trade that of the hanging man. Of course, we don't just up into the market because we saw the hanging man. Of course, no. We wait for the next candle to validate if this market truly is going to do what, to sell. And so once we do that, we can find a significant level, say somewhere around here, to want to take a trade, and then we can have our stop loss above or at the low, at the highest price of the hanging man, and then we look for also another significant level to want to what, take profits, right? So this is the stop loss. This is where we got into the market. That is our EP, and then we are looking to take to take profit here. Okay, so this is a typical example of a sell setup. A typical example of a sell setup. We are taking profits below where we enter the market because, of course, if you're selling, you're expecting prices to depreciate, and that's how we make profits. If you're buying, you're expecting to prices to appreciate above where you enter the market, your entry price. That's how you make what, profits. Okay, so this is typical example of buy setup, typical example of what, a sell setup. All right, so these are the ways that we can use to trade these signals that will be generated by the candles. Okay, the next we'll talk about is the inverted hammer and the shooting star. The inverted hammer and the shooting star. Now, the inverted hammer and the shooting star looks really identical, all right? Only that the inverted hammer is a bullish reversal candle, while the shooting star is a bearish reversal candle. So it's just like the hammer that we had, the hammer and the hanging man, all right? The hammer just turned upside down becomes the inverted hammer. All right, then the hanging man also turned upside down becomes what we call the what, the shooting star. All right, so once we find the armor, the inverted armor rather, at the end of a downtrend still, it indicates what, it indicates the weakness of the sellers and that prices may likely rise up again. All right, and then you can also have all of those trade setups, find significant level after the next candlestick which validates the setup to want to enter the market. Okay, now, note that all candlestick chart patterns needs validation from the next price action and other market sentiments, all right, like trend lines, pivot points, support and resistance, and so on. Now, candlesticks in itself alone is good, but using the candlestick alone might not give you 100% accuracy, and that's why those candlesticks, when you find the signals that it generates, try to validate those signals using your idea on trend lines, on pivot points, on support and resistance. And I'm going to be teaching you trend lines and on pivot point and also support and resistance, of which I've talked about support and resistance before now. Okay, so let's see if we could find any on the market. Let's see if we could find any. This is what we call a bullish engulfing pattern, so we will come to that. We will come to the bullish engulfing pattern just very shortly. So I'm trying to see if I could find uh, the hanging man, yeah, or the shooting star, or the hammer. Okay, beautiful. Watch this. All right. Watch this. This is what? What do we call this? All right. So what do we call this? This is the shooting star, right? The shooting star we said is the inverted what? Hanging man. All right. So let's go back and see. This is a shooting star, and we said once we find the shooting star at the end of an uptrend, all right, there is most likely to be what, a significant a fall in the market. All right. So this is the shooting star. So once we see the shooting star, you can notice that the market has actually been buying. What this simply means is that the strength of these buyers are gradually nosediving, and that prices would most likely what, fall. So what do we do if we're trading this? We probably must have found out our support and resistance and also our trend lines to ensure that this is actually going to be right to sell. Then we validate this, we find this shooting star, we validate it with the next candle, at least the next candle moving towards the midpoint of the previous bullish candle tells us that okay, sellers mean business and would want to most likely take prices further below. So we can take our trade at this high. You can see there is a significant high here. So we can take our entry here, and then to we can look towards um we can look towards the next significant level. There was a little range in here, so we can take our profit there for sell, and then we can also have our stop loss here. All right, so this is your stop loss, this is your entry, and then this is your what, your take profits. All right, so beautiful, beautiful setup. All right, so once we go ahead, you can find all of these, you can find all of these, you can find all of these. I mean, you can find them. Okay. All right, so let's quickly get back. So at your leisure time, you can go through your charts and find all of these candlesticks that we've learned. All right, so the dual candlesticks, let's talk about a little about the dual candlesticks chart patterns. Now, when we talk about dual, we simply talk about two candlesticks combining together to give us a trade signal or a technique on which we can use to what, to trade. Now, first we talk about the engulfing pattern, right? There are two types of engulfing candlestick patterns. There are two types of engulfing candlestick what patterns. The first we have the bullish engulfing, and then the next we have the bearish what, engulfing. Now, the bullish engulfing occur when a bearish candle is immediately succeeded by a larger bullish candle, just like we have in this case. All right, a bearish candle is immediately succeeded by a larger bullish candle which completely covers it. So we say that it has engulfed this candle. And most times, if you find this at the end of a downtrend, then it can signal a possible bullish movement. It could possibly signal a rise in the market. And then the bearish engulfing occur when a bullish candle is immediately succeeded by a larger bearish candlestick. All right, just like we have here, the bullish candle is immediately succeeded by a larger bearish candle which completely what, engulfs it. So this is bearish engulfing, this is bullish engulfing. Now the bullish engulfing pattern should be ignored if the combination of the two candlesticks does not occur after a downtrend. All right, you get that? So it must, the bearish engulfing pattern, you must find it happen at the end of a downtrend before you can say that okay, it is what, valid. But it is not valid if you don't find it at the end of a downtrend. Now, likewise, the bearish engulfing pattern, if it does not occur after an uptrend. All right, so you should find this at the end of what, an uptrend before it is valid. So if we go back to our charts, if we go back to our charts, we can still find some of those engulfing. Okay, watch this. Let's watch this closely. Oh, I just found something. I can't see it anymore. Okay, watch this now. The market was actually selling, and then we found this at a significant support level. This is a significant support level. Let me show you. This is what we're looking at. Now, this is a significant support level. This is a significant support level here. Can you find this now? This is a significant support level. The market kept testing this particular area of the market. All right. but was unable to break through the market. Now, the market actually remember what we talked about in the beginner's course, that at support you do what you buy. So the market actually started having the pull up, right? And then we have this engulfing after the market fell back to the support, all right? So now, because the market fell back to the support and the support hates upward movement, and then we have the bullish engulfing here. We had the bullish engulfing here. You can find the bullish engulfing. Why did we say this is a bullish engulfing? Let's look at it closely. Why did we say this is a bullish engulfing? Why? Because after the market fell back to the support, the bearish candle was immediately succeeded by a larger bullish candle which completely covers it. If you notice, it covers it completely. So this is a bullish what? Engulfing pattern. This is a bullish engulfing pattern. But do we rush to trade this? No, we can still wait for more validation from the next candlestick. If the next candlestick that forms is a bullish candle and then it drives above the close, above the eye of the first candle, then we can say, okay, this trend is valid for buy. So what we do is to find a significant level to want to take trade. So I think this level is okay for us to take a buy order, and then we can have our stop loss at the lower week of this, and then we can target to close trades here, that is the top of this, and well above that we can find more significant levels to want to possibly close our trades. So this is a nice trade setup. So here we enter the market EP, and here we have take profits, and also here we have our stop loss. All right, now if you had actually taken a trade like that, okay, if you had actually taken a trade like that, watch this, that you enter the market here and then you put your stop loss here. This is 10 points, sorry, this is 10 pips. So you're risking 10 pips to get 16 pips. So this is 17 pips. I mean to say this is almost 1 to 2 risk reward what ratio. Almost 1 to 10 risk reward ratio. So this is beautiful. This is how you can find all of these opportunities in the market. All right. I hope this is making so much sense to us. Whoosh. Okay, so that is bullish and bearish engulfing patterns. You can, at your leisure time, find all of these, find the support zones, the resistance zones, and then find the engulfing patterns and other patterns that we've learned and practice it. All right, so the next we have the piercing line patterns. The piercing line patterns. This is a bullish reversal pattern, and to get a stronger validation of each signal than an existing downtrend is a prerequisite. All right. In the formation, the first candle must be a bearish candle. Okay. In the prerequisite, we're talking about the combination of the combination of candles to make the pattern. The first candle must be what? A bearish candle with a large real body, and the second candle should be a bullish candle which opens below the previous candles and closes above the middle of the previous bullish what candle. So this is what we mean, all right? There usually is it's more like a jump in the market. Okay, I experienced that on Euro GBP. I experienced that. Was it no, last week? Yeah, last week. Beautiful. I experienced exactly the piercing line pattern on Euro GBP last week, and I'm going to find it and show it to you. All right. So for you to have the piercing line pattern, the first candlestick in the formation should be a bearish candle with large real body. And then the next candlestick that is going to form should be a bullish candle, but it should form below. There should be a jump. Remember that this is the close of this price here, is the close of this bearish candle here, right? I'm not able to get it right. So yeah, this level, this is the close of this bearish candle. Now the next candlestick was supposed to start forming from the close of the bearish candle. But what happens is that the next bullish candle that is supposed to start forming from the close of the previous candle will now have a jump and start forming below this candle. All right. Now once it starts forming below this candle, it closes a little above or at the midpoint, at least the midpoint of this particular what candle. Now, just like you have here, then we can say this is a piercing line what pattern. This is a piercing line pattern, and it is what a bullish. It is a bullish reversal pattern. Now, the opposite of the piercing line is what we call the dark cloud pattern. The dark cloud pattern. This is the opposite of the piercing line pattern. It is a bearish reversal pattern which is well validated at the end of an uptrend. Now, in the formation, the first candlestick is a bullish candle followed by a bearish candle that opens above. You can see this now slightly above here. Okay, it opens above the high of the previous candle, which is a bullish candle, but closes below the middle of the first candle, just like we have here, right? Just like we have here. It closes above the middle of this candle. So we can call this the dark cloud pattern, the dark cloud pattern. So I was saying I want to find the piercing line pattern because it happened on Euro GBP. Yeah, it happened on Euro GBP, but we will better appreciate it if we look at it from H4. If we look at it from H4, we will appreciate it. Oh, where is it? Where is it? Where is it? I think I know it happened on Euro GBP, right? Okay. All right. Okay. Okay. Yeah. Beautiful. Beautiful. This is it. Now, this is it. Beautiful. I found it. Yup. Now, this is it. Now, watch this. Watch this. Um, this is where the market closed. This is where the market closed. Remember, we talked about closing and opening prices of um, any market, right? Now, this is where the market closed. Let me use a line. Let me use a line. This is where the market closed. Beautiful. This is the level that the market closed. But the next candlestick is supposed to start forming here. But what it did is that it jumped and it started forming here instead. It started forming here instead. You see this now? Now, it closed above this. It closed above the body of this. In fact, this got past the middle of this previous candle. All right. Now, this may likely be what signals a bullish movement. And the most beautiful thing is that this is found at the end of a downtrend. This is found at the end of what? A downtrend. Okay. So, coming. All right. So this signaled a bullish movement and it is found at the end of a downtrend. If you watch this, this is this is a major support zone. This is a major support zone. All right. So when I'll talk about support, I will still explain to you while this is a major support zone. You can notice how prices got to this place and got stuck, and it had been moving within this support zone. The next we're expecting is that prices will most likely obey the rule of support, the rule of supply and demand. All right. So that is it. Okay, so let's go, let's go, let's go. All right, so piercing line and dark cloud. The last candlestick we want to talk about is the morning star patterns. It's what? The morning star pattern. Now, the morning star pattern is a three candlestick formation pattern which warns of a potential bullish what? Reversal. Now, in the formation, we have the first candle as a bear candle with relatively large real body. All right, this is a bear candle in the formation. All right, with relatively large rebody. This is looking like the Marubuzu we talked about. Okay, now the second candle is the star, which has a small body. It can be any color, which simply means it can be, when we say it can be any color, we simply mean it can be a bear candle, it can be a bull candle. All right, but any color. But let it be that it has a small real body and shows the weakness of the sellers in taking prices low. If you look at this candle very well, this is the second candle that has small real body. If you look at it very well, this looks like the spinning top. And we said one of the things that the spinning top does is to signal what, that the weakness of the buyers or sellers, depending on the previous dominating trend, is coming to exhaustion. So yeah, the trend is what has been bearish. Now, if we find the spinning top after a candle, after the Marubuzu, um it simply tells you that the strength of the sellers are getting to what, exhaustion. Now the third candle is what completes the whole setup. Now the third candle confirms that the weakness of the sellers, the third candle confirms the weakness of the sellers as buyers take over the market and drive prices to close beyond the midpoint of the first candle, beyond this midpoint. So once we have a setup like this setup warns us of a potential what, bullish what, reversal. Beautiful. So you can find this at your leisure time, the morning star. And then the evening star is just the direct opposite of the morning star. But in the formation, the first candle is a bullish candle with relatively large real body. The second candle can be any color, but let it be a spinning top. I mean a spinning top. The closing price is close to the opening price. All right. But it can be any color. It can be bullish candle. It can be bearish candle. And then the third candle is what confirms the weakness of the buyers, as sellers will enter the market and drive the prices to close beyond the midpoint of this first candle. And that is why we are having this. This is the midpoint of this candle, right? Oh, sorry, I'm not able to draw that straight line. All right, so this is like the midpoint. All right. So the sellers are able to drive prices beyond the midpoint of the first candle. So this warns us of a what? A potential bearish reversal. Beautiful. So we can find all of these candles and put them to practice. Now, you probably may not be able to get all of them at your fingertips or just today or just by watching this video once or twice. Now, mastery comes with practice. You have to keep looking them out, how they form, and the more you keep trading, the more you will encounter them. And once you encounter them, "Oh, I've encountered this candle." It sticks to your head. So when next you encounter them, you just smile at the market and be like, "Oh, I know exactly what is going to happen in this market." All right. Now that is practice. Practice helps you to gain mastery. All right. So let's quickly look at the next important thing on our course outline, which is the trend lines. Now we're getting deeper, it's getting more exciting, getting more interesting. All right, I still need you to keep jotting down. The trend lines are straight lines drawn on the charts to connect at least two highest prices or two lowest what, prices. Trend lines are straight lines drawn on the chart to connect at least two highest prices or two lowest what, prices. Now it takes 2 points to draw a trend line, but the validity of that trend line is confirmed by a third point which touches the what, the line that is being drawn. The more the points that touches the line, the stronger the trend. The more the points that we can find that touches the drawn trend line, the stronger the trend. Now there are two types of trend lines. There are two types of what, trend lines. The first is the downtrend. So the downtrend is a trend identified by lower highs and lower lows. A trend identified by lower highs and lower lows. And I'm going to explain that very shortly. While the uptrend is a trend that is identified by what? Higher highs and higher lows. Higher lows, right? Higher highs and higher lows is an uptrend, and a downtrend, which is a bearish trend, is identified by lower highs and lower lows. So this is what exactly I mean. If you watch the market, If you watch your forex chart, the market goes in this pattern. All right, it goes in this pattern. Now, now, um, this is a bullish trend, right? This is an uptrend. We can say that this is an uptrend. Merely looking at it, we can say this is an uptrend. Why? Because it's going up. Beautiful. Now, it is an uptrend. Why? Because it is identified by higher highs, all right, and higher lows. So, permit me. All right. So this is an I. This is another I. This is another I. This is another I. This is a low. This is a low. This is a low. This is a low. Now, beautiful. Now, if you watch this is a series of higher highs, right? And a series of higher lows. Now, this is how we are able to identify what an uptrend is. An uptrend is identified by a series of higher highs and a series of what? Higher lows. But the reverse is the case for a bearish trend. All right. So a bearish trend moves in this manner. So we can have series of what? Series of lower highs. This low is lower than this is lower than this, series of lower highs, and also series of what? Lower lows. Now we can call that what? A bearish what? Trend. So let's see if we can spot these on the live chart. Let's see if we can spot these on the live chart. All right, so this is a live chart, right? Now, how do we know that this is a bearish trend? All right, how do we know this is a bearish trend? We would know by the eyes. So this is a high. This is a high. All right, this is another high. This is another high. This is another high. This is another high, right? Sorry, I made that too. This is another high. And then we have the lows. This is a low. This is this is a low. 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 Now, if you watch this, you can see that this is a what? A downtrend. Why? Because it is made up of series of lower highs and lower what? Lows. Now, if this if this market moves and breaks this high, if the market moves and breaks this high, then we would probably be expecting that it has had a reversal because of this support zone that is here. So we are expecting that the market will continue to go bullish to create another high that will be greater than this high that it has broken. It simply means that we can say the market has changed direction from series of lower highs and lower lows to begin to form higher highs. And once it begins to form higher highs, it simply means automatically the market is in what? In bullish trend. All right. So once it forms a high that is higher than this high level, it will fall back to create a low. From that low, we can now expect that it will pull up again to create a high higher than the previous high that had been formed. All right. Now, this is a typical example of what? A bullish or a bearish what? Trade. A bullish or a bearish trend rather. Okay. Now, some importance of trend lines to traders are: number one, that it helps the trader to determine the overall sentiment of the market. It helps the trader to determine the overall sentiment of the market. Number two, to spot best points to enter the market for buy or for sell. Best to spot best points to enter the market for buy or for what? For sell. All right. Just like I have stated in the previous charts. All right. Once we have this high lower than this high, we're expecting the market is going to create another low that should be lower than the previous low. So already we know that, okay, it is best for us to take a trade here, and we're expecting that the market is going to fall, breaking the previous low because it's a what? A downtrend. All right, it's a simple psychology, so it helps you to know the best to spot best times to get into the market, either for buy or for sell. Now, how do we draw our trend lines? How do we draw trend lines? Number one rule in drawing a trend line is focus mainly on the major swing points. I'm going to show you that just shortly. Number two is connect at least two major swing points. Remember that the third swing point confirms the trend. And then lastly, adjust your line so you can get the most touches. Just like we used to draw line of best fits. All right. So how do we draw the trend line? Pick this. This is the trend line. All right. This is what we use to draw trend line. Pick it up. And then once you pick it, we can find this, the low of this port, right? This is a major swing point. It's a major swing point, and then we can draw that trend line. Now, watch this, that the market was able to touch these swing points, right? And then also at this point, it touched the swing point. Now, should the market come back to this trend line, we're expecting a pull up, but if it breaks this trend line, then we know that the market has changed direction to begin to go bearish. All right. If the market breaks this trend line just like it did here, it broke the trend line, then we should be expecting a movement down to the downside. Or else, if it comes and doesn't break this, then we should be expecting it to create another high that is higher than this previously set high level. Does that make sense? Of course it does. All right. So this is how we can draw our trend lines, right? Let me find more opportunities still on this asset and then see how we can draw those trend lines. Beautiful. All right, pick your trend line, locate the major swing point, like this is a major swing point, and draw your trend lines. All right, draw your trend line. All right, so you notice that it touched here, it touched there, and also touched here. All right. Now, there are times that it would slightly want to touch the trend line. This is what we call the trend line. All right. This is the trend line we've just drawn. There are times it will want to touch the trend lines, but didn't really touch. All right. So, one of the things that we're going to be learning next is to see how we can also factor in these spots. All right, they are also spots that were supposed to be on the trend line, all right, but it didn't touch. So we are going to, when we answer the question of dynamic support and resistance, we are also going to talk about that. So with this, we can draw our trend lines. All right, we can draw our trend lines, find the opportunity, draw the trend line such that um, it touches most of the points. All right, that it touches most of the points, just like we have here, 1, 2, 3, and 4. All right. So, and that is it. So that's how we can actually draw our trend line. Okay. That's how we can draw our trend line. Um, so for an uptrend, from this example, you see how the trend line touches major of the swing points. Touches majority of the swing points. All right. Now, one of the things that the trend line will help you to identify is the best, a good spot to enter the market for buy or for sell. So once we're able to identify the trend line being drawn properly, then whenever the market comes to the trend line, for instance, in this case, these trend lines now act as a support. And remember, we said at support we do what? We buy. So at this point was a good spot to buy. This spot here was a good spot to buy. And then when it fell back again to the trend line, this spot would have been a good spot to buy. All right. And here also a good spot to buy, a good spot to buy, because there's a pull up, there's a pull up, there's a pull up, and there's a pull up. All right. So this is how we can use the supports, the trend line to identify um buy and sell opportunity. The same happens for that of the downtrend. All right. Whenever it pulls up to the trend line, it's a good spot to take a sell order. It pulls up, is a good spot to take a sell order, except it breaks this trend line. Once it breaks this trend line, it is most likely to what? Continue. All right. Once there is a trend breakout, it is most likely to what? Continue. This is a good spot to sell, except it breaks. All right. So having known how to draw the trend line and also use the trend line to spot opportunities, what are dynamic supports and resistance? Dynamic support and resistance will actually help us to figure in, to put in, to factor in rather, those spots in the trend that was created that didn't touch the trend line. All right. So, but what are dynamic support and resistance? We're going to answer that using the moving average. So first, let's answer what the moving average is, and then we can use it to answer what dynamic support and resistance actually are. Now, a moving average is an indicator that is used, one, to understand market directions, two, to predict support and resistance areas, and three, to also know potential trend reversals. All right. So these are the things that we would be looking at on how to use the moving average, and or what rather the moving average is used for. It's a trend indicator that is used to understand market directions, predict support and resistance areas, and potential trend what reversals. So the different types of moving averages are, one, the simple moving average, which is popularly known as the SMA, the exponential moving average, the linear weighted moving average, and then the smoothened moving average. These are four popular types of moving averages. The most popular moving average are the averages of 15, 50, 100, and 200 days period. Now I'm going to be explaining that shortly. Now, often adopted for different trading purposes. Now, depending on the period of the moving average that you're using, it depends on your trading purpose. Most times, banks and hedge funds and institutions love to use the 100 and 200-day period. All right. And if they're trading huge volumes, they can use even up to 500 or 800-day period on the moving average. But for retail traders, for scalpers, they would want to use a smaller period, which will give them trade setups and trade signals for them to identify what happens in the market really quick, and they get in and get out of the market also really quick. Now, support and resistance are called dynamic, all right, when they are constantly changing depending on the recent price action, unlike the kind we find on the horizontal trend lines. So unlike this type we find on the horizontal trend line that is drawn, that the prices come to touch the horizontal trend lines. Unlike these, dynamic support and resistance are constantly changing because of the recent prices of that particular asset in the market. All right. So this is the moving average. This is the moving average. Once we install the moving average, which everybody has on this chart, we can use that moving average to identify support and resistance. Now, this is the 50 period moving average that is installed on this chart. Now, notice how the price action touched the SMA 50, simple moving average 50. This 50 simply says the period of the simple moving average. Now, notice how the price action touched the SMA 50 several times, giving you great trade setups. So if we want to draw, our trend line, we will have something like this. Forgive me, I'm trying to do a freehand sketching. Okay, I think this will do. You are okay. So let me use these instead. All right, beautiful. You can see this now. So the question is, the market touched here. This is a major swing point. A major swing point. We said a trend line can be drawn touching 2 points, but the third point confirms that that trend is actually what? A downtrend. And just like it is, this is the third point, the third time the price action was touching the trend line. So it confirms a downtrend. All right. And then what about these points that did not touch the trend line? What about this point that did not touch the trend line? Or what about this zone that did not touch the trend line? All right. There are also swing points. All right. But how can we identify them? That is where the dynamic support and resistance comes in. And we have to use the moving average to spot these points because there are also opportunities for us to buy or to sell. All right. So once you install your simple moving average, especially of period 50 or 100, as the case may be, depending on what you want to look at the market, then you can have these spots. The spot the whenever the price action touches the moving average, all right, the moving average now acts as a resistance. In this case, it acted as a resistance here. It acted as a resistance here. So we could find an opportunity here to sell, here also to sell, this spot also to sell, this spot also to what? To sell. All right, until the price action, when I mean price action, the candlesticks move and breaks the supports, the moving average, all right, then starts moving above the moving average, then we can see that there is a breakout also on that moving average, and then we can find new opportunities on the buy. Okay, so let's see more examples. All right, look how nice how the price action touched also the simple moving average here, creating an opportunity for buy here too, here also, and here also, creating opportunities forward for buy. All right, so how can we actually have the moving average installed on on our system or our laptops? It's simple. You go to insert, go to indicators, and then you come down to trend, because the moving average is a trend indicator, and here you find the moving average. So insert indicators, trend, and then you find moving average. All right, so you click on the moving average. All right, the period is already 50. Let's install it and see. Beautiful, beautiful. So notice how coming notice how opportunities were created whenever the market touched the moving average. This is a dynamic support. This is a dynamic support. This is a dynamic resistance. A dynamic resistance here as well, creating opportunity for sell. All right. So beautiful, beautiful. Okay. We also find here a dynamic what? Resistance. So we're expecting market to pull down, of which it eventually did. Okay. So yes. So should the market, remember what I said earlier, that if the price action breaks through this moving average and starts to form above it, then we will be expecting what? We will be expecting a bullish movement, a movement to the upside. Look how whenever it broke through this and starts to form above, we had a bullish movement. If it broke through this and starts to form below, look how nicely it acted. We had a bearish movement. All right. we had a bullish movement. After the breakthrough, we had a bearish movement after the breakthrough. Right? This is a fundamental. Else, this would have acted nicely as well and go through. Right? But then there was still a corrective move after the big fundamental news, and then the market still acted nicely. All right. So this is how we can use the moving average to find dynamic support and also dynamic what resistance. So let's talk about how we can use moving average crossovers to also find opportunities. Let's talk about how we can use moving average crossovers to find opportunities. Now, moving average crossovers can be good technical tools to help traders identify when to get in and out of the market. It occurs when when two or more moving average lines cross over one another. Okay, the moving average crossovers can be used to determine the following: one, the overall direction prices may be trending; two, the potential entry points through the market; and three, potential trend reversals, or to identify the end of a particular trend. All right. Now, in this example I was giving, we had two moving average. This is a moving average 10, and this is a moving average what 20. Now, whenever the moving average 10 crosses the moving average 20 and starts forming below with the price action forming below the two moving averages, then we have a sell signal. So look at where it crossed over. We had a sell signal here. We would probably have taken a sell order, right? And then the market acted nicely by selling. And then when it crossed over again above the 20 period moving average, we said the sentiment of the market um, is now bullish, right? So we find bullish opportunities. And then remember, whenever it falls down to the moving average, that is a dynamic support. We find opportunity to what? To buy. Whenever I fall down, opportunity to what? To buy. And then until it crosses over here again, we have a sentiment down to the downtrend. All right. So whenever it crosses, it creates opportunities. It gives us potential entry points to the market for either buy or for sell. And then it also helps us to identify a potential reversal. Like here, the market has been selling, but when it crossed over, we know okay, the sentiment had changed from sell down toward to buy sentiment. All right. So this is how we can use the crossovers in our everyday trading, and it's pretty easy. It's so simple that we can use it for our everyday trading and still maximize the most of the market, the opportunities in the market. All right. So let's go back. You can still let me still show you how to insert that. So this is a simple moving average of 50, right? So I'm not going to take away that, rather I'm going to add more. So remember I said insert indicators, trend, and then we find on the trend the moving average. Now in this case we are going to have the period change to what? 10. The period I talk about change to 10. All right. Then we can have the smoothened, right? Remember we talked about the different types of the moving averages: simple, exponential, smoothing, and linear weighted moving average. So this time around we are using, say, the exponential, all right, and then apply to close. Let's change this color so we know. Red is for exponential moving average, what? 10. All right. Beautiful. So this is what it looks like. And then we can have this is two moving average already, but let's use 10 and 20 because they are somewhat close. All right. So it can give us a quick signal. All right. So this time around, we still have the moving average, but this time around with period of what? 20, still exponential. This time applied to open. Let's change the color. Let's have the color as blue. All right. So we can identify that blue is period EMA 20, exponential moving average 20. Beautiful. So just with these now we can find the opportunities. All right. Okay, let's take the 50 period moving average. Okay, let's go with one period first. Let's go with crossovers first. Notice how we always had a signal whenever the moving average crossed each other. So it crosses here, we have the sell signal and it's sold, right? So we could probably take a sell trade around here. We could take a sell trade around here, and then we follow the trend, we ride the trend. So long as it is not crossed, we ride that trend until it crosses. So this is where it crossed, right? This is where it crossed. So we would close our trade somewhere around here. We have opened a trade here and we are closing here. Now let's try to see how many pips that would have been if we had followed just this simple strategy. It works, it is effective, and trust me, now this is on H4 time frame. You can use it on lower time frames as well. All right. Now from here, you would, and then you close your trade here, right? Close your trade somewhere around here. This is 113 pips. 113 pips. All right. 113 pips. Even if you're trading with the smallest lot size, you probably would have made some good money for yourself. Okay. Notice how also Notice how also after the crossover here, the market acted nicely. After the EMA 10, the exponential moving at 10, average 10, crossover the exponential moving average 20, creating a buy opportunity here, right? Created a buy opportunity here. So if we are taking a trade around here, we would have rode this trend until it closed here. This is where it closed. So let's say we close our trade here. Now, if we are to check how many pips that would have been, watch this. We closed somewhere around here. This is 67 pips. Did you see that? Now, if you stick to a simple strategy even as this, you would make the most of the market. It creates opportunity. This is an opportunity to sell. Did it sell? Yes, of course it did sell. Yeah, it is crossing again, which means that most likely it is going to create an opportunity for us to what buy. By the time the EMA 10 crosses above the exponential moving average 20, and then the price action starts forming up, so it creates an opportunity for us to what to buy. So you see how simple this could be. With this simple strategy, I can tell you that you can make the most out of the market. So this is for moving average crossovers. Let's look at the relative strength index. The relative strength index. The relative strength index is an indicator that helps traders to evaluate when an asset is underpriced or overpriced. When an asset is what? Underpriced or overpriced. Its value ranges from 0 to 100, which can be used for either trend identification or reversal identification. All right. So the relative strength index has values that ranges from 0 to 30 to 100, but specifically they have it has the calibrations between 0 to 100, which is commonly used to identify the trend reversals. All right. Now for trend identification, this is what happens if the RSI value, that is the relative strength index value, is over 50. This indicates a bullish sentiment, and below 50 indicates a bearish sentiment. I'm going to show you that real quick on the chart on the live market. Now for reversal identification, remember we said that it can be used to identify trend and also identify reversals. So for trend, if the RSI value is above 50, that shows you, that indicates a bullish sentiment, and if it's below 50, it indicates what? A bearish sentiment. All right. Now for reversal identification, if the value of the RSI falls 30 and below, it interprets that the asset is oversold or undervalued. All right. So once it is on oversold or undervalued condition, which may signal a possible change in trend or a corrective move to the upside. I'm going to show you this very shortly. And if the values of the RSI is 70 and above, is interpreted that the asset is in overbought or overpriced condition, which may signal a possible change in trend or corrective move to the what? To the downside. So let's quickly have the RSI, and then we would um, see how it works. So let's take off the MACD. Beautiful. So For you to install the RSI, you still come to insert, comes indicators, and then the RSI is an oscillator. So you come to oscillator, and then you find the relative strength index here, right? Imputing the relative strength index, all right. You can leave the period at default. You can leave the period at default, all right, and then say okay. Okay, so yeah, you notice that we have the calibration of 30 and what 70, which falls between the 0 and what 100. Remember what we earlier said? We said that for trend identification, right? For trend identification, this is the RSI value, 51.99, right? If the RSI value is above 50, what it means is that the sentiment of the market is what? Bullish. All right, so we can use other methods to find a bullish opportunity. And if the value of the RSI is below 50, we can say that the market is in what? A bearish what? Sentiment. Is in a bearish dominance or a bearish what? Sentiment. More so, we went ahead to say that if the market gets to, if the RSI value falls to 30, all right, or below 30, what that simply means is that the price is undervalued or oversold, and buyers may likely get in the market and push prices a little higher. All right, so we can use that to identify a reversal or a corrective move to the upside. And then if the prices gets to 70, it simply means that the price of that asset is overpriced or overbought. All right. And so what happens is that sellers will up in the market and tries to push prices a little below. Okay. So it could be a reversal or it could be also a corrective move. So let's quickly take a look at this. So this is at 70, right? Now, if you watch this port here, this is 70. This is a 70, right? Now, this is where the market fell. So let me use this. Okay, beautiful, beautiful. And then one more, so I would be able to explain that. Now, watch this. The market fell below 30, right? It fell below 30 and got to this point. So below this 30, yeah. And then at this port, below that 30, we have this. All right, now watch these, how nicely this played out. When the market got to 30, all right, it broke 30, and below the 30, we were expecting that the strength of the sellers were getting to exhaustion. So buyers will hop in the market and try to push prices up. And that's exactly what happened at this port here. The strength of the sellers finally got exhausted, buyers up in the market and push prices up here. In this case, the RSI got to 70. You can see that here. This is a 70, right? So when it got there, what that simply means is that the buyers the this particular asset euro gbp is now overbought. So what happens is that the sellers were up in the market and tries to push market a little lower. That is a corrective move we're talking about that we saw here. The same thing happened when it got above 70 here. All right, sellers up in the market and push prices below. All right, so we use um we use the RSI to try to know the sentiment, all right, of the market players. All right, if an asset is overbought or oversold, and what may most likely what happen. Okay, all right. So let's talk about the last. Okay, so you can see how displayed out. Look, this was the chart that was displayed here first. This is the same chart, right? But this is a bigger picture of it. On what chart is this? All right. So this is a bigger picture of it, right? Now, notice how the RSI, this is the RSI value. Notice how the RSI got to the 30 level and below the 30 level, creating opportunities for what? For a buy, all right, and for a sell. So it is at this point here, we have a little sell opportunity, all right? At this point, we had the market was oversold and will most likely go up, and yeah, the market was overbought and will most likely what come down, right? So we have the pull up. Sorry, come in. All right. So yeah, all right. So we have. I'm not able to draw that. I'm not able to draw that wall. Yeah, exactly. So this is the correct line. So notice how at this point it was reading above 70. The market obeyed nicely and had a pull down. All right. So please, I want to say this, the RSI, it's not used to produce signals, all right? It's used to identify the trend and also to help us understand when an asset is overpriced or underpriced and what may most likely happen if we know if it is overpriced, all right? Okay. So let's talk about the last four today. The moving average convergence and divergence. The moving average convergence and divergence. Now, the moving average convergence and divergence, popularly known as the MACD, all right, is a technical indicator that aims to help traders. Sorry about that. The MACD is a technical indicator that helps traders to identify changes in the momentum. All right. Please take note of this word momentum. Take note of this word momentum. All right. Okay. Take note of this word momentum. All right. So it helps traders to identify the momentum, the changes in the momentum of prices, and identify new trends as well. Now, many traders use the MACD to identify whether the bullish or bearish movement in the prices of any asset is strengthening or weakening. All right. So, majorly, the MACD is that indicator that we can use to identify if the price of an asset is strengthening or it is getting weak, right? It has its default settings as 12, 26, and 9. It has its default setting as 12, 26, and what? And 9. Now, the MACD features are the MACD line, all right? All right, so let me quickly show us the MACD. Let me quickly show us the MACD, put out the RSI. All right, so we follow the same process to put on the MACD, insert indicators. The MACD is an oscillator, all right? So we have this MACD, all right? But this wouldn't buttress what about to explain, so I have to use the other MACD. Okay, close. Now insert indicators, and I can come to custom. I already have the MACD um, here. Yep. Beautiful. So this is the MACD. All right. So let's go explain how the MACD works. So we have the MACD line. All right, it's the faster moving average, which is a difference of the 12 and 26 period moving averages. Remember, we said that the default setting of the MACD is 12, 26, and 9 period moving averages, which makes up the MACD. All right, so the MACD line is considered the faster moving average between the moving average setups, and it's the difference between the 12 and 26 period moving average. Then we have the MACD signal line. All right, the MACD signal line, it's the slower moving average which is a period of 9 exponential moving average. Then we have the MACD histograms. The MACD histograms, all right, sorry about this. So the MACD histograms are graphical representations of the difference between the MACD line and the signal line. I'm going to show you all of these once we look at the chart next. Okay, and then we also have the MACD baseline, also called the center line or zero line. All right, so let me show you the futures. So this is the MACD baseline or the center line. All right, this level which we have here, it's a crossover between the lower part and then the upper part. Is called the MACD zero line. All right, and then um, we also have the MACD line. This is the MACD line. Okay, it's considered the fast moving average. All right, it gets there before the others. Okay, and then we have the MACD signal line. All right, we have the MACD signal line, which is this red, right? We have the MACD signal line, which is this red, all right? And then we also have what else did we talk about? We talked about the MACD line, the signal line, the histograms, or yeah, the MACD histograms. So the histograms are these that are formed below, the red bars, and then the green bars that are formed above. Okay, now let's quickly go back and see how the MACD works, how to trade with the MACD. Now, when the MACD line, which is a faster moving average, moves away from the signal line, it shows strengthening momentum. It shows that there is the strength of either the buyers or the sellers much, right? It's strengthened. There is momentum in the market. And when both lines are close, it shows weak momentum. All right. So let's quickly find out here. There is what you see how the signal line moves, sorry, you see how the MACD line moves away from the signal line. Yes, exactly. This simply tells you that there is momentum in the market and there's going to be a nice ride in the market. So watch how there is a nice ride all through this point. Are you seeing how there is a nice ride? But when we have the MACD and its the MACD and the signal line are close, right? It shows this that there is no much strength, there is no much momentum in the market. The sellers or the buyers, depending on where we find it, does not have enough strength to push prices in their favor, and that's one of the meaning. All right. The next is when new trends begin, the faster moving average, which is the margin line, moves and crosses the slower moving average, which is the signal line. All right. So once the faster MA moves and crosses the slower MA, we then see that it could possibly be that there is going to be a new trend. All right. So just like we have here, right? So this is a faster moving average. It moved and crossed the slower moving average, thereby creating a bullish signal, all right, which we find finally displayed or finally happen around here. But most often times, we do not use the MACD to want to generate signals. We use it to know if the strength of the buyers or the sellers, if the buyers or the sellers rather still have enough momentum to push prices in their favor. All right. Okay. The MACD line and the signal line moving above the center line shows a bullish sentiment, and below the center line shows a bearish what sentiment. So when the MACD line and its signal line move above this zero line, it shows what a bullish what sentiment. Watch how when the MACD line moves above the signal line here. Okay, let's have something to draw it here. Watch how when it moves above this zero line or the center line, which is here, if we should draw a straight line, right? Now, what it simply means when it moves above the zero line is that there is a bullish sentiment or a bullish dominance in the market. And so we would probably have looked out for a bullish dominance from around here. We would be looking out for from around this candle, right? We would be looking out for a bullish what? A bullish sentiment in the market, all right? And then if we have the MACD line and the signal line move below, if it moves below the zero line, then we say that there is going to be a bearish what sentiment. So long it moves below the zero line, there is a bearish sentiment. So watch how the MACD line and the signal line broke through this zero line somewhere around here to begin to move downward. All right. So we find a bearish opportunity. We find a bearish opportunity. The market moving downwards somewhere around here, and so long it continued moving below the zero line, okay, then we can say that the market is still in a bearish what dominance, just like we have all through here. So notice this, that the moving average is getting to the zero line. If it crosses the zero line and starts moving above the zero line, all right, it's one of the confirmations we can have in addition to the moving average crossovers. Remember, we talked about the moving average crossovers wanting to give us a buy signal here. Now, if the MACD moved, if the MACD line and the signal line moved above this zero line to the upside, that is a confirmation of this buy setup that is forming up or that is teaming up here. All right. Now, this is how we can use the MACD. Look at it's going. If it starts to form above the zero line, right? It's a confirmation of the buy setup that is building up here. All right. So this is how we can use the MACD. This is how we can use the MACD. All right. This is how we can use the MACD. So this is a perfect example. All right. Whenever the MACD signal line whenever the MACD line crosses the signal line, yeah, it creates a sell opportunity, right? Create a sell opportunity, which invariably happened here that we saw. And then here also, all right, this is the signal line, the red, the blue is the MACD line, all right. So here also we have the sell opportunity created, and then of course it did sell. And here also we can see that from here, and of course it did sell. Now this part, we remember we said that if the MACD line and the signal line are very close to each other, what it simply indicates is what? Weak momentum. It simply means that there is an activity going on, but you would not see much of the volume that will drive prices much to the favor of the bulls or the bears. So in this case here, we have the weak momentum. Look how the MACD line and the signal line are close to each other, and you see it display here. There is an activity, but you see small body candles. Remember, we said small body candle simply shows that there is what? Small activities in the market, low volume in the market. All right. So this is how we can use the MACD. All right. So Thank you so much for staying from the beginning till the end of the intermediate course series. Should you have any question, please do well to contact me. Ask me all of your questions, and I'll be super glad to attend to your questions and help you become the professional trader that you want to be. Thank you so much as always, and see you in the advanced class. Thank you.